In this video, I'm going to show you a classic covered call stock buyback for which the stock has gone higher than my strike price. I don't want my shares taken away. I have to take action. I'm going to show you what I did with one of my favorite utility stocks this past week. I know you're going to like it. And at the end, I'm going to show you how you can up your covered call gain. Stick around. This is going to be a good one.
Let me show you my
Hey, welcome back everyone. It is time for another red hot covered call video. Before I get to that awesome trade, and I'll tell you what, man, I absolutely love the trade and how it worked out. Look, I want to make mention. I'm going to start doing a midweek covered call car session podcast. I get so much positive feedback that people just want me to do a podcast. They want me to just talk about a topic, whether it's about a specific trade, maybe it's about a specific fundamental when it comes to the selling premium strategy, maybe it's just my opinion on the various different things that come with the stock market. Well, I'm able to do that with my covered call car session podcast. And what I'm going to do, I'm going to post up a midweek podcast. I do want to give you more, man. There are so many great topics that we do on the podcast. I want to bring them here to the channel. So look for these midweek updates, podcasts. They usually take about 30 minutes. I hope you enjoy them. If you like what you're hearing today, I want you to subscribe to the channel. It's right there and it's free. And hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. And what we're doing is this. We're doing videos every single week trying to up your game. And today's video is about a trade I did where I take a great stock that I'm just looking to collect a dividend. It's a buy and hold dividend capture strategy where I buy a great utility stock. They pay 4 and 5% in an annual dividend and we just hold it. Well, if you've been watching my channel, you know I love to use these stocks when they get a little bit overbought. Because from my experience, these utility stocks run in cycles, right? The market will look to take risk off the board, so they'll buy utilities. When it's time to buy those riskier stocks, they'll come out of the utilities. So utilities have this nice ebb and flow. So what I like to do is when the stock's near all-time highs or they're higher in the Keltner channel, I love to write that topside covered call, maybe a 30-day covered call, out of the money enough where my shares won't be taken away, because this is not a strategy for which I want my shares taken away. I just want to collect a 25-cent premium or a 30-cent premium. And for me, I love playing it because I can get that extra dividend. Hell, look, I even came up with a spreadsheet. I call it doubling my dividend spreadsheet, where I actually keep track, where I write covered calls on these great dividend utility stocks. But I try to write that deep out of the money covered call every once in a while. I don't do it all the time, but when I do, that's the goal. The goal is it never gets to that strike price. I keep the premium and I'm going to keep the stock anyway, right? Companies like Southern and Chevron and Dominion, I'm keeping them. So for me, that's what I want to do. I did that with Southern, and I'll tell you what, Southern went higher than my strike price, and I had to take action. Let me show you that trade right now. Now let's do a quick summary on Southern. Southern is a utility company, one of the biggest. You could see it as a $64 billion market cap. It's a huge utility stock. And I'll tell you what, love Southern. You could see where Southern just plays in this nice little cyclical move up and down. Love playing it. It also pays a fat dividend, 4%. And I'll tell you, Southern's hitting all-time highs. So most of the time, that dividend's about 5%. And Wall Street likes that. They actually like the 5% because, hey, when it comes to dividends, if a stock's paying too much on a dividend percentage, sometimes Wall Street doesn't like that. They feel a little shaky that a company can pay out a 5 and 6% dividend. Now, with Southern, what do I love to do? Well, as you can see, as Southern goes up, I'm thinking it's going to peel back. This is a 5-year chart. So as Southern goes up and up and up, what I love to do is write those topside covered calls with the expectation that the stock is going to fall every single time. Now, I'm writing deep out of the money covered calls. So I'm looking to just pick up 20 cents, 30 cents with the likelihood it'll never get to my strike price, never have my shares taken away, but I collect that 1 or 2 extra dividends, quote unquote, and I could just play the game. What do I always tell you, man? I need to stay excited. I need to stay motivated. So these little things keep me motivated. So setting up this trade, it's really simple. I mean, Southern has absolutely exploded, just like a lot of utility stocks. There's a lot of volatility in the stock market, so there is money flowing to these more conservative plays. Well, I did not think when Southern hit about 58 right here that it would actually bounce right off of support right there and head higher. I thought this thing would peel off. Look, there are a ton of articles out there right now talking about how these stocks are overbought and a pullback is going to happen. Well, that's not happening. Well, I read into that, and I'll be honest with you, when I wrote that covered call, I totally thought it was going to fall back. I thought it might even fall back to here. Well, what happens? In a 30-day period, Southern goes higher. I had a $60 strike, never expecting it to get there. And I only got 42 cents for that. But again, that's part of the plan. That's part of the plan. I rate that deep out of the money strike, pick up about 42 cents. I got 1,000 shares, so that's $420 in the bag. Take it, we move on. Well, as you could see, on the Friday of expiration, just yesterday, the stock was trading above $60. Now, here's how this plays out. Because it's above $60, even if it's 1 penny over $60, my shares are going to be taken away. The market maker will snatch up my shares. Well, in this case, the stock's trading for $61.77, so they're absolutely going to take my shares. Here's the problem. I don't want my shares taken away. I have owned Southern back here when it's trading for $44. I have a huge capital gains bill if my shares are taken away. So I'm dancing this fine line, and this time got snapped off. So I have to do something. It's Friday. Luckily, they haven't taken my shares, so I have time to act. So what did I do? Well, if I buy back the option, right? Think about this for a second. I got paid 42 cents for this option. At expiration, what is the option trading for? Well, we know it's a $60 strike, and the stock is trading at $61.77. So there's $1.77 of real money. Now, there's no time value because we only have hours for expiration. What I end up doing, when the stock is at $61.89, I buy this back for $1.89. Do you see that? Do you see where there's $1.89 real money? The option is now trading for $1.89. Now, chances are the stock may have ticked down to $61.88, and I bought it back for $1.89. That would be $1.88 of real value and 1 penny of time value. Well, that probably happened in a blink of an eye. All I know is I bought this option back, alleviating the obligation for $1.89. Well, in this scenario, get rid of the 42 cents, and I now added about $1.50 to my cost basis, right? To alleviate this obligation, to take it away from that person, right? They can't take away my shares at 60. I had to pay $1.89 for this option. I got paid 42 cents. So scratch out the 42 cents I got. What am I left with? I'm left with about $1.50. That $1.50 I paid out. It goes to my cost basis. So where I once had a cost basis of 44, we'll add $1.50 to it. I'm now at a cost basis of 45.50. Well, what do I do? At first I was thinking, you know what? I'll just take it. I've made so much profit in this. I'll do it again. I'm going to keep this. But then Southern starts to fall, and I'm thinking to myself, look, what do I want to do here? Well, I end up writing an in-the-money covered call, but I gave myself 4 months. See, if I truly believe that Southern is going to peel off, a nice little bit of downside protection is going to work great for me right here. So what I did was this. So I can go ahead and recoup some of that $1.50 that I paid, adding to my cost basis, I wrote about a 4-month covered call. What I did was I wrote a 60 in-the-money covered call. I got paid $3.17. Now, from a percentage basis, this does not look good. Right? I mean, I'm giving my shares away at 60. So between 60 and 61.77, that's real money. There's no profit there in this $3.17 option. But again, my hunch is that we are going to get that peel off. A lot of articles are coming out saying, look, these stocks are overbought and Southern's true value might be around 55. Now, look, I don't know if it's going to get there, but you could see Southern's history does show a nice little rally. It gets overextended and then they bring it back. So what I'm hoping here is this. Over the next couple months, it trades sideways to down. And as it trades down, this option will be reduced. And I got $3.17 on 1,000 shares paid up front to give somebody the right to take my shares away from me in January for $60. Now, as this stock falls, I hope it will, this option is going to be reduced. It's going to slowly come down as the stock comes down. And what I'm really hoping to do is buy this thing back under $1. Now, this trade in theory would execute in January of 2020. I'll have my shares taken away, and if they take my shares away, the capital gains will affect my 2020 tax year. To be honest with you, I didn't want this gain affecting this year. So that's why I played this 4-month gap. Now, granted, I could have sat on my hands, but I added $1.50 to cost basis. I want to do something here. Now, what's my biggest fear here? I don't really mind if my shares are taken away at 60. I mean, it is what it is. The biggest fear is this. In November, we're going to get a dividend. dividend, 60-cent dividend. So this stock, if it's trading above 63, right? Above 63, because the call buyer paid me $3. So they're losing money if they take ownership of the stock anywhere below 63. But if the stock gets above 63, then they can take the shares, collect the dividend, sell the shares, and make a profit. Probably won't take the risk of a stock trading at 61 or 62 just to get a 60-cent dividend. That's my biggest fear, getting past the fourth quarter dividend. Now, if it does, I'm holding the stock. I'm going to collect that dividend, and we'll probably move into January. And hopefully, again, I'll be able to buy this option back, not have my shares taken away, and we repeat and rinse, and we'll do it time and time again. At the beginning of this video, I told you I was going to show you how you can up your covered call game. Look, all I can tell you is this. Over the past 3 years, I've done over 700 successful trades. It keeps flowing like water. Absolutely enjoy what I'm doing. See, I finally have success in the stock market. Now look, a lot of people ask me all the time, John, how do you find that next great covered call stocks? There's so many of them, I don't know how to even get in the game buying a great covered call stock. Well, look, you can go to my website, ctpdashboard.com, download your free copy of this week's updated CTP dashboard. You open it up and you get to see 100 of the best trading stocks now to start your research. Look, nobody's just going to send you a PDF file or red hot stock tip in email that you should just buy. We always need to start where we're going to do our own research. And we need to have that list so we can then go out and do our own due diligence so we can feel it and we can take ownership of it. So look, I offer that up to you for free on my website, ctpdashboard.com. I don't charge you nothing. And I have the free spreadsheets that I talk about in my videos where you can track all of your numbers. You have to keep all your numbers in front of you if you're going to do multiple stocks multiple times a month. I offer them up to you for free. Don't ask you for a nickel. Take advantage of all the free resources that I give you. Look, if you're going to go out and pay a guru, make sure you have your experience first. You don't want to be like me, paying the gurus $50 a month, 1 month, 2 months. By the third month, feeling like a loser because I'm not using it. I wasn't ready. I want you to be ready if you're going to pay a guru that kind of money every single month. So look, get your starter kit here. Get your starter kit at ctpdashboard.com. I want you to go there. I want you to get comfortable with all this because when you feel comfortable, you'll do it. Look, free dashboard right there. Click on it. It's there for free. Now look, if you like what you heard today, it's real easy. Just subscribe to the channel. It's right there. We try to do this every single week. I come back every week, share with you my experiences, show you some trades so you get comfortable with it because I know if you get comfortable with it, you're going to do it. And when you do it, you're going to have success. Hey, look, I absolutely wish you all the best in trading. Use the free resources at my website and go to my Facebook page and join. We have a conversation off YouTube there every single day. Love all the comments. There's a lot of like-minded, smart people out there. Ask your questions. Be engaged. Hey, look, until next time, I hope all your covered calls are profitable.